Great, thank you. So here we have Gideon and Mey, and we're all good. So thank you for. So what I thought is, it's all good to kind of sit here and tell you guys about what will get investors across the line. But I wanted to introduce you to Gideon and Mey, two friends of mine who are actual investors who've recently closed deals in the Nordics to kind of compare notes and contrast. So just to give a brief intro, I thought I'd kind of mention Mey. She's an investor at Project A. Before Project A, she worked a couple of years at Goldman in London before moving back to Berlin to join Telia, a healthcare startup. After gaining really valuable operating experience there for a couple of years, she started with Project A, where she's been involved in plenty of startups in the Nordics, including Butter and Dixa in Denmark, as well as Pactum in Estonia. My other friend today is Gideon, who's a investor on Entrée Capital based out of London. Before Entrée, Gideon spent time in investment banking. He then redeemed himself at Monzo, a challenger bank in London, and one of the great investments Accel has made in the recent years. His most recent investment is also in a yet-to-be-disclosed Nordic company, so we can't get too much into detail. But rest assured that these investors both have a lot of experience investing in the Nordics. Great. So with that, I always find the best way to get a real impression of someone's approach is to kind of use real-life examples. You've both recently closed investments in the Nordics. So Mey, I was thinking maybe, would you mind walking us kind of through one of that process or a process like that, and kind of explain to us what stood out to you in the meeting with the founders and what kind of got you over the line?
Sure, of course. First of all, thanks for having me. I guess, in terms of the details of the funding round, I think Butter was a very special case because it just went really fast. I think that was a deal that we closed within 5 days. So it's probably not kind of the standard case to be presenting. I guess from my perspective, I guess one of the ones that have kind of like a really fairy tale kind of process was actually Pactum, which was also one of the first investments that the first investment that we did completely remotely. So it had a special spin to it. And in terms of the process, the way it happened is that we kind of talked to the founders already for their pre-seed round, so when they were raising kind of their angel round. And at the time, we already kind of straight away fell in love with the founders, and that we thought 3 founders, 2 of them are brothers, everyone with really strong expertise in their own field of work. And then we kind of parked it because it was very early for us. As soon as we kind of heard that there's some movement happening for their seed round, we were like, okay, we definitely have to speak to them. And again, all the topics that we kind of spoke to them in this pre-seed round, we were like, okay, we need more validation on these and these and these topics. You could exactly tell that they have been working exactly on these type of things. We're super agile in developing the product, had made extreme progress with kind of very, very large enterprise clients. And then from there, it went really fast. It was still pre-product, pre-revenue. But we kind of started off with kind of the catch-up meeting, then partner meeting, went straight into kind of our commercial due diligence, which in this case was basically just market research, product DD, and an investment committee. And after that, it went really fast. So I think even before, giving a term sheet, we already had this understanding and really good relationship with the founders. So that was kind of clear that that's going to be a wedding that's going to happen.
Yeah. So it sounds like that was pretty key in terms of developing the relationship over time, allowing you to move fastly. Could you talk, what does that look like specifically, kind of from your first meeting to you actually see the seed? What happens in between there?
Yeah, I think there's especially, I guess, in the last year because of Corona and things have just been moving faster. I feel like there's 2 types of deals that VCs do now. It's the kind of, you hear about a company, you pester the company until they speak to you, and then you try to get it through ASAP. And for that, what is really helpful to kind of have like hypothesis on a specific industry beforehand. So what we do is basically each one of us in the team, we have our industry deep dive. So for example, I do digital health and B2B marketplaces and some other topics. So I know exactly what I'm looking for. So then if these like last minute, we want to close by tomorrow deals come by, it's much easier to make a decision. And then you have the other ones, which, for example, Pactum was one of, where we spoke to the founders and then we just, regularly catch up. Like you just want to, we have like this like list of companies, or I have the list of companies that I'm really keen on, where I just make sure that I'm in the founder's mind, at the top of his mind all the time, especially when he thinks about raising a fund. And that includes like just catching up regularly. If I see competitors, I send it to them. If there's kind of any like angels or kind of someone in the network that could be helpful for them, introduce them and just, make sure that you're also, adding value even before investing, so that they want to work with you. And then when it comes to like the round where you can be relevant, it's about, deepening that kind of relationship, but also in that case, checking if the tick boxes that the last time were missing have been solved. It's also about kind of understanding that the founders really like appreciated your feedback and kind of worked on the feedback that you gave them before, which kind of shows also that they're, first of all, kind of like listening to feedback, are maybe a little bit coachable as well, and are just agile and open to change things.
Cool. That makes perfect sense. Thank you. Gideon, what about you? Would you be able to tell us a little bit about a fundraising process that you went through here to kind of understand what got you excited?
Yeah, absolutely. So I think there's for some reason I've looked at quite a large number of deals in the region over the last 6 months. Part of it might be the relationship with Einar, and so we've looked at a lot of deals. We've gone deep on a handful, and kind of recently pulled the trigger on one that unfortunately is not public yet. And I guess as I reflect on those, kind of all of those learnings, I would say that, of course, there's what was really the difference between the one we did and the ones we spent time on and didn't do. And there's probably a list of reasons that are unrelated to geography, right? That are just normal kind of VC reasons around team and product. But I think if I strip out, I think a key learning that would be relevant to a founder who is from the region, I would say that there's kind of this basically like there is with any country that isn't the US, there's always a question about market size as it relates to a product that's going to, maybe dominate a single market, but not necessarily dominate globally. And so when you're coming from a market that is not the US or where there isn't like a kind of an easy continental play, then investors essentially have to ask themselves this kind of further question around product market fit and differentiation. Like if a product might be doing very well in a market and there's clear evidence of product market fit, and there's even kind of hockey stick type growth, revenue, customer growth metrics, and everything can look like an amazing company, but go deeper and you realize, and I think this happened to us on a couple of things we didn't do, that maybe more than half the B2B customers are local customers. Maybe it's something about Danish companies that just love working with other Danish companies, but in a scenario like that, you as an investor have to ask yourself, is this product going to be the best product in Sweden, Denmark, and Finland, or is it going to be the best product globally? Because if it's not going to be the best product globally, then you kind of capped on the upside. And so if I was a founder building a product in that market, I would either build for a big market first, or have really thought through how the product is going to be truly differentiated when it goes beyond the local market. So the deal we've done, which hopefully will get announced soon, the team has essentially not even don't even see themselves as I won't say the country, but as that country, they see themselves as a US product. They've said we're going to build a product in the US and we're going to build the best product there. And our competitive landscape is basically American and European companies. And so there's an ambition there that a kind of a global investor can easily get behind. Whereas some of the ones we said no to had amazing teams and amazing products, but there wasn't, and already traction and growth, but there wasn't a clear path to being a globally differentiated product, if that all makes sense.
That makes perfect sense. Thank you. Mey, how does that resonate with you? Do you feel the same way, or how does that sit?
Yeah, totally. But I think maybe to add is that it also oftentimes depends on kind of what the product is. So, for example, if you're like selling to, like large enterprises, etc., and you're building a SaaS product, then oftentimes, of course, it makes much more sense if you go global. There's also a few cases, though, where I think you're building SaaS for example, SME. And there, I think, closing a country like Germany, for example, is already a massive market. So, for example, Podium in the US, right? They're just in the US. It's a massive market, and I could potentially think that, if a product like that was just as successful in Europe, I don't know if it's going to work or not, but if it was, then just Europe or just Germany by itself would already be a massive market, So I think I totally agree, and I think that's actually one of the advantages that I see in kind of the Nordic countries is that because the individual markets there are relatively limited to, for example, a US, they kind of tend to think more global straight away. So I've rarely seen, Nordic founders building for their specific country, but they think about like straight away at the pre-seed or seed stage, where can I go? UK, Germany, US, etc.
How, without getting into too much detail maybe, but like how did this play out for you while you were considering the investment in Pactum, for example? Like, did you think about international expansion, how to like measure or how to predict that? What was the process there?
Yeah, again, like Pactum is a bit of a special case because they are literally just targeting kind of the Fortune 500, the most like the largest companies in the world initially, which you can't do locally anyway. So most of them are international companies. One of the founders also kind of lives most of the time in the US and had previously exited a company in the US. So they already had kind of that global angle. And I think the product by itself, you can't do local. So you need the corporates. And I think the corporates that they're working with now are spread across quite evenly between the US and Europe. Got it.
That makes sense. And how about you, Gideon? Like how do you, so you kind of, I think we've established that global presence and rollout is important and kind of key. How do you think about assessing that when you talk to people? Like what can they, like, do you have any process for understanding, how relevant this is for other markets, for example, or how do you think about it?
Yeah, so I think absolutely there's a number of things you would look for as an investor. I think, I guess the first is just around mindset, especially at very early stages, like is the founding team really thinking about the global market? And the way to assess that would be like, looking at the kind of test data that they're looking at, which early customers are they talking to and where are they from? Who are they comparing themselves to, right? Like on their competitive landscape, is it a list of, like European companies that you know about, or is it broader than that? And so on. So that's kind of the first, and then second, so that's kind of on mindset. And then with regards to actual early traction, I think it's simple. I think I alluded to it before. Where's the money coming from, right? Like, is it 3 or 4 local businesses that that the founding team already used to work with somewhere else in that market, or is it like big bad dominating US or European companies? I think I'm kind of thinking about B2B SaaS, if that works. Yeah, so I think you just got to look a bit deeper on where the revenue is actually coming from. And so if you're a founder, you're probably you're probably thinking just to make sure you can show in those ways that you're thinking about those markets, you're also working in those markets. And then finally, I think from like the product differentiation point, because this came up, I think the key problem for us on some of the ones we didn't do was that there wasn't a clear thesis around how the product would be different to products that existed in other parts of the world. And so I think, there has to be a clear thesis on what's going to be built that's unique, comparing to players that aren't just local.
Got it. Makes sense. Great. Thank you. So essentially kind of summarizing, I think the key takeaways there. So develop the relationship early, really approach things with a global mindset, and make sure that you think about differentiation and how to compete on the global stage. That's what it sounds like. Cool. Well, thank you guys. That was super helpful, and thank you for those insights. Now I think it's probably time to open the floor up to the questions from you, the audience, to see if you can try to reveal how little we actually know about these things. So let's see if we can get some questions through in the chat, maybe, if Jan is feverishly sending them through. Let's give it a couple of seconds here. It's tough. All right, cool. I think we have the first question here. So, I guess this flips the script a little. What are the key things to consider when it comes to selecting an investor beyond capital? What should we as entrepreneurs be looking for? So, Mey, maybe you want to start and give some perspective.
Yes, I mean, I could go into pitch mode for Project A now because we have a massive value add. No, I mean, what we do specifically, in case you don't know, is that we actually have quite an operational approach. So we have 90 full-time experts in-house that work with our portfolio companies, basically like an extended arm, and that's kind of one of our value adds, or how we differentiate ourselves. But apart from that, I think you can see that a lot when you sit in board meetings. I think it is, I mean, it sounds really lame, but it is a marriage in the end, right? You basically contractually decide to spend kind of the life cycle of the company with and share it with certain people. So I think you just need to really, really be on the same page with your investors, and kind of to an extent where, things are not going to always go smoothly, and there's going to be difficult decisions to be made. And if you need to be sure that the investor has, the best interest of the company in mind, and also the founder in mind, and is, just as a human relatable, I think that makes a massive difference. And then apart from that, obviously, I think also helping with just in general the network as well. When it comes to because we invested in early stages, so it'd be how does a relationship work with the investors that come after us? Can we facilitate any kind of fundraising requirements that you have, etc. Just we're basically there to make your life easier and to support you. I think we're not there to pester you and to annoy you and create extra work. That's for sure.
Cool. Anything to add to that, Gideon? Or?
I would say maybe just a reframe, because I think the point is the same around getting to know people well. I think from my time as both an operator, founder, and now investor, I think my takeaway on this is by the time you as a founder, take money from someone, they should already feel like your partner. I think it's those are the relationships that do best. You've spent months with them. They've already helped your business. You're already talking to them about scaling problems. and they have already become a go-to person. And and I think that's kind of usually a good sign, that a sign of good things to come. And so I think good fundraising CEOs spend a lot of time fundraising, not because they're always fundraising, but because they're always getting to know potential partners well, right? Whereas kind of less good fundraising CEOs, which I've been, by the way, spend all their time fundraising because they're always fundraising and always trying to fundraise, as opposed to kind of build the relationships and really discern who is a partner before they actually take their money.
Got it. That makes complete sense. Cool. Moving on, I think we have another question. So what's a reasonable amount to invest at seed stage and A stage, and how much dilution should you be expecting to take in each round? So this is obviously a great topic, one that we love to talk about a lot, at least I do. But I don't know, Mey, maybe you want to take the first stab, or what's your view here?
I mean, it's very hard to say, actually. I mean, it's first of all, depending on kind of the investor you're talking to, but I mean, in the last year, the amounts raised in pre-seed, seed, and Series A, I mean, the labels pre-seed, seed, Series A have just become very blurry. So, rounds have become much larger than they used to be, et cetera, et cetera. So it's hard from an investor perspective to actually say, what is a normal amount for a seed round, for example. I think it always depends, again, like at what you're building and what you need the money for. If you need something that needs to like quick execution and you need to go out and sell a lot, then you might need more money, or if you need like some kind of working capital, you need more money, etc. But to be honest, I wouldn't pinpoint a specific number at this point in time. It just really depends on how much you need, and also be mindful that, if you raise a lot now, then, and you don't make like massive progress until the next round, and you want obviously to go up in terms of the funding round that you raise for the next round, then you just need to be aware that there's a certain risk kind of associated with raising massive rounds at the very early stages if you can't deliver kind of the development and the traction that was kind of meant to be with the money that you raised. Very fluffy answer.
Perfect VC answer. Gideon, how are you? Anything to add? Or?
Nothing major to add. I mean, I think just if you're a founder, start with your end in mind, right? Like if you want to build, if you know you want to raise $1 billion and try and build a $10 billion company, then you're going to dilute a lot over the next few years. And, and so that should very much guide your starting point. But if you're like, if you're going to just like open a shop, if you're going to build if you plan to not raise a lot, then obviously you can afford to dilute a bit more. I guess no major insights.
Got it. And then so next one is more of a go-to-market one, and let's start with you, Gideon. And so the question is, what successful go-to-market models have you seen in SaaS in Europe or in the Nordics specifically, and how do they differ between kind of ACV sizes? So, Gideon, I don't know if you have any experience with this.
I mean, I could talk about kind of one topical SaaS model in the fintech space at the moment, which is, kind of in embedded finance. So a hot space, it's been for a while. There are a number of interesting companies, I think, across consumer, business, finance, as well as now insurance, lending, and other things. I think investor, so if I just comment on one particular insight is, I think it's easier for an investor to get excited about distribution that doesn't require a huge amount of brand building, right? Because there's just so many companies competing for the attention, like brand attention of customers. And so I think in kind of today, it's easier for investors to get excited about go-to-market strategies that can truly leverage off existing consumer and business-facing brands. So typically that would be these embedded products that can plug into much bigger products like Shopify or Amazon or etc. And do that via kind of an API or a plugin or SDKs or whatever from a technical perspective. And so I think it's worth just mentioning, I probably won't say that much more on it, that if you can build a business that, that can do, lowers the threshold for investors to get excited about go-to-market and distribution.
Makes total sense. Mey, how about you?
Yeah, I think it also depends on just generally like who your target customers are. I mean, on kind of the enterprise level, it's oftentimes about, direct relationships and like long sales processes, but oftentimes worth the investment because just the ACVs are so much larger. And then some stuff that I've seen that worked quite well. I mean, for example, with butter, a lot of it is also kind of a sense of virality. So it's workshops, that you do on butter. Where you oftentimes have external people take part in these events, and it's very much like a product-driven like expansion system in that the product is just amazing. So it's just very fun to use. Like it just looks cool, and once you see it, you will recognize it again, and that's how kind of the virality works there. And then kind of especially on the SaaS side, where they sell to very small. Like the small of the SME kind of section, oftentimes what works is kind of like third-party leverage in that I don't know, if you're selling to small e-commerce shops, use something like a Shopify marketplace or like some kind of multipliers that can help you reach more, grab more land quicker.
Makes sense. All right, so maybe for our final question to wrap things up, so there's a question here. It goes to Gideon. So Gideon says you mentioned around kind of competing with the big bad U.S. companies. How do you have any examples of differentiation or companies you've seen that successfully have kind of competed or differentiated themselves in terms of this international kind of competition?
Yeah, I mean, do they need to be from the Nordic region?
No.
Okay.
So, we're not totally Nordic constrained here. We're just trying to learn how can we kind of convince investors that, I know Google's out there, or like I know Microsoft's out there, but my product still has value.
So examples, I mean, there's examples. So definitely. So, along the theme of fintech, embedded finance, and also talking our own portfolio a little bit. There's an Israeli startup called Rapid, RAPYD. They are what's called a fintech as a service platform, which I think doesn't mean much, but essentially they enable e-commerce businesses to offer various forms of financial services, from kind of payments, various payment solution in a very easy way, along with a number of other things, KYC, fraud, card issuance, etc. They are kind of classic SaaS API business, and the founders are Israeli, and a lot of the teams in Israel, but they have 100% built a product for a global market. And some of their first customers were very big US customers. I think, they've also just happened to be one of the fastest growing technology companies to come out of Israel, certainly recently, like maybe ever. And so that, I think if I was building a SaaS or API business and was looking for a role model, I would probably look at them kind of towards the top of my list. And then I think there's also a company, this is not in our portfolio, but I've come across recently, and it's a Danish company called Pento, that has done really well now in the UK and Europe, and there's tons of people doing it. So I'm potentially helping you and some other investors by mentioning it. But I think that's an HR and payroll business. And as on the topic of Nordics, I think they would be a good example of a Danish company that's managed to get good product market fit in the UK and other parts of Europe, at least.
Cool. Thank you. Taking us home, Mey, anything to add to that, or?
Not much. I mean, I guess, no, actually, not much to add. I'm just looking into the chat. There's also another question about the kind of the founding teams question.
Let's take that one if you want. So
yeah, I was actually thinking about that quite a bit. What are the different things that within founding teams are super impressive? And I think, I don't know if you would agree with me, but that oftentimes is kind of like how complementary is the skill set of the founding team. So I feel like, I mean, depending on what industry you're in, you need like one person that has, I guess, the expertise within an industry, and then kind of complementary to that, have someone with like kind of more a business mindset or kind of an execution mindset. Taking again the example of Pactum, it was kind of like one CEO who's just the sales machine, one product guy who's just obsessed with products and geeks out at it, and the other one is kind of the AI expert that just geeks out on everything AI. So everyone owns their space very much and has expertise in it, and then overarching, they have the same mission, and kind of are always, like have the same mission, but are experts in their own specific field, and no one can really tell them like what they should do because they just know it so much better. I think that's just really impressive when we have that.
Cool. That makes total sense. And then maybe, it seems like we have another couple of minutes to spare, so why don't we go ahead. So there's a question from Alan here about, if you're already making revenue, is it any way worth taking investment? Gideon, what would you say to that?
I mean, I think you've got to just be clear on where you want to get to. So again, like start with the end in mind. I think if you're making enough revenue to cover your cost base, and you and you don't feel like you need capital to outspend your competition on marketing, then the answer to this question is no. But I think in this day and age, that's uncommon, and usually companies, most companies that have ambitions to dominate a market or many markets need a lot of capital to spend on marketing and hiring, and are usually and often spend many years making revenue but not yet profitable. And even if they were profitable, it might still not be enough to kind of compete with the best companies out there. So I think this answers this question for most startups is yes, and certainly for ones that are trying to dominate a vertical, and a market.
Anything to add to that, Mey?
I think it's all about where you want to go. I mean, if you're already making revenue and you're profitable and you want to and you're happy with that, then that's obviously totally fine. I'm sure you can build a solid business. If you want to, IPO in 3 years, then most likely you will need some external capital to invest in, like hiring, marketing, expansion, etc., etc. And in those cases, it's useful for you, but you have to know where you want to go.
Yeah, no, it makes total sense. I think it's key with alignment, both between the founders, but also inside of the investor base itself, that you make sure that you have investors who are aligned, so VCs, family offices, and so forth. Well, I think that was what we had time for today. Thank you, Gideon and Mey, for taking the time to join us. Thank you all of you for listening. I hope you found some takeaways that were valuable to you, and enjoy the rest of the conference.
Thanks, Einar. Thanks, everyone. Bye-bye.